What if you don't need $100,000 sitting in your bank account to start investing in real estate? Most people believe that, and it's the single biggest reason they never take the first step. Here is the truth. Real estate has created more millionaires than almost any other asset class, and the core principles behind it have not changed in decades. Whether you are watching this today or coming back to it 5 years from now, what I am about to share with you applies regardless of interest rates, market cycles, or what the headlines are saying. This is not a hype video. There are no get rich quick promises here. Instead, I am going to walk you through the actual foundations of how real estate builds wealth over time. You will understand exactly how properties generate returns through multiple channels most people never think about. You will learn the specific numbers and metrics that separate a deal worth pursuing from one that will drain your bank account. And you will discover where profitable deals actually come from, even in markets where everyone swears there is nothing left to buy. By the end of this video, you will have a complete framework for evaluating real estate opportunities with confidence. Think of this as your go-to guide, the kind of education that would normally cost you thousands at a weekend seminar, except everything here is built on timeless principles, not trends that expire next quarter. Now, before we go any further, let me tell you exactly who this video was made for. If you're brand new to real estate investing, completely overwhelmed by all the conflicting advice online, or you've been burned before by hype and flashy promises, this is made for you. Maybe you understand you want to build wealth through real estate, but you're not sure where to actually start. Or maybe you're the type of person who needs to understand the why behind something before you dive into the how. Either way, you're in the right place. This isn't a get-rich-quick pitch either. There's no secret loophole we're selling you today. What we're covering across this entire video are the genuine foundational principles that actually drive real estate investing, the stuff that works regardless of what the market is doing. Solid fundamentals don't care about hype cycles. So whether you're starting from zero, coming back after a bad experience, or just trying to cut through the noise, stick around because this was built specifically with you in mind. Everything you need to actually understand this space starts right here. Quick disclaimer before we get into the good stuff. Everything in this video is strictly for educational purposes only. Nothing here is legal, financial, or professional investment advice of any kind. Real estate investing involves real risk, results vary widely, and absolutely no outcome is guaranteed. What works for one person may not work for another. Before making any financial decisions, please do your own thorough research and speak with licensed professionals who understand your specific situation. Got it? Great. Now let's keep moving. I'm going to walk you through exactly what this entire video covers, so you know precisely what you're about to learn. I want you to pay close attention because this roadmap is going to save you from making the mistakes that cost most new investors thousands of dollars before they ever see a return. We are breaking this down into 3 foundational pillars, not hacks, not shortcuts, just the core concepts that every successful real estate investor understands. Pillar 1 is how real estate actually generates wealth. We are talking cash flow, appreciation, leverage, and tax advantages working together simultaneously. Pillar 2 is the numbers, specifically, which metrics tell you whether a deal is worth pursuing or worth walking away from fast. And pillar 3 is where deals actually come from, and more importantly, why there are always opportunities available when you know how to approach buying correctly. These 3 pillars build on each other. Master all 3, and you will have a framework that works regardless of what the market is doing. So let us start with pillar 1 right now, because understanding how real estate actually makes money changes everything about how you evaluate opportunities going forward. Most people think real estate investing is just about buying a property and hoping it goes up in value. And sure, appreciation is part of it. But if that's all you understand, you're missing 4 other powerful ways that real estate puts money in your pocket. So let me break down the 5 engines of wealth in real estate, because once you see how they all work together, you'll understand why so many millionaires have been built through property. Engine number 1 is cash flow. This is the money left over after you collect rent and pay all your expenses. Your mortgage, insurance, property taxes, maintenance, management fees, all of it. Whatever remains is cash flow, and it hits your account every single month. This is the lifeblood of real estate investing because it gives you income you can actually live on or reinvest. A property might not make you rich overnight, but consistent monthly cash flow compounds into something incredibly powerful over years. Engine number two is appreciation. Over long periods of time, real estate tends to increase in value. Now, you never want to bank entirely on appreciation because markets do fluctuate, but historically, property values have trended upward over decades. Think of appreciation as the bonus on top of everything else. You didn't have to do anything extra, you just held the asset and time did the work. Engine number three is one that almost nobody talks about, and it's called loan paydown. When you have a tenant paying rent, a portion of that rent goes toward your mortgage payment, and every mortgage payment chips away at the principal balance of your loan. So essentially, someone else is paying down your debt for you. Month after month, your equity grows not because the property went up in value, but because the amount you owe keeps shrinking. This is silent wealth building happening in the background. Engine number four is tax advantages. The government actually incentivizes real estate ownership through the tax code. You can deduct things like mortgage interest, property taxes, insurance, repairs, and even the theoretical wear and tear on the building itself through something called depreciation. Depreciation is especially powerful because it's a paper loss. The property might actually be gaining value, but on your tax return, you're showing a loss. That can offset your rental income and sometimes even reduce the taxes you owe on other income. Always work with a qualified tax professional on this, but just know that the tax benefits in real estate are significant and they're baked into the system by design. Engine number five, and this is the one that ties everything together, is leverage. Leverage means you're using borrowed money to control a much larger asset. If you put down a percentage of a property's purchase price and finance the rest, you now control 100% of that asset while only investing a fraction of the total cost. If that property goes up in value, you earn the return on the entire property, not just the amount you put in. That's what makes real estate returns so outsized compared to many other investments. Your cash flow, your appreciation, your loan paydown, and your tax benefits are all amplified because you're working with leverage. Now, here's where it gets really exciting. These five engines don't work in isolation. They stack on top of each other simultaneously. While you're collecting cash flow every month, your tenant is also paying down your loan, the property is likely appreciating over time, you're getting tax deductions that reduce what you owe, and leverage is magnifying all of it. That's the real reason real estate creates wealth. It's not one thing, it's five things working in parallel on every single deal you own. So that's how real estate actually makes money. These concepts are timeless. They applied 50 years ago, they apply today, and they'll apply decades from now, regardless of what the market is doing. Now that you understand the wealth building engines, the next question becomes, how do you actually evaluate whether a specific deal is worth doing? That's exactly what we're covering next when we dive into the key metrics every investor needs to know. So stick with me here. Now that you understand how real estate generates wealth, we need to talk about the numbers. Because here is the truth that separates people who build real portfolios from people who lose their shirts. It all comes down to a handful of metrics. If you know these numbers cold, you can evaluate any deal in any market at any time. These are timeless. They worked 20 years ago, they work right now, and they will work 20 years from now. Let us start with the big one, net operating income, or NOI. This is the total revenue a property generates minus all of your operating expenses. I am talking about property management, insurance, taxes, maintenance, vacancies, all of it. But here is what you do not include. You do not include your mortgage payment. NOI is about the property's performance before debt comes into the picture. Think of it as the property's raw earning power. If you remember nothing else from this section, remember NOI because almost every other metric builds on top of it. Next up is cap rate, short for capitalization rate. This one is simple math. You take the NOI and divide it by the purchase price of the property. What you get is a percentage that tells you the return the property generates independent of how you financed it. A higher cap rate generally signals a higher return but often comes with higher risk. A lower cap rate usually means a more stable market or property, but your returns are thinner. Cap rate is your quick comparison tool. When you are looking at 2 or 3 deals side by side, cap rate helps you stack them up fast. Now here's where it gets personal to you specifically. Cash on cash return. This metric measures how much cash you actually earn relative to how much cash you actually invested. So if you put $50,000 into a deal and at the end of the year you pocket 5,000 in profit, after all expenses and debt payments, your cash on cash return is 10%. This is the number that tells you how hard your money is working for you in a specific deal with your specific financing. Then there is the 1% rule. This is a quick screening tool, not a final answer. The idea is that a rental property's monthly rent should be at least 1% of the total purchase price. So a $200,000 property should ideally rent for $2,000 a month or more. If a deal passes the 1% rule, it is worth digging deeper. If it does not, you might want to move on unless other factors are exceptionally strong. Finally, ARV, which stands for after repair value. This one matters most if you are looking at properties that need work. ARV is what the property will be worth after renovations are complete. You figure this out by looking at comparable properties in the area that are already in good condition. The gap between what you pay plus your rehab costs and the ARV is where your potential profit lives. Now, here is why I'm spending this much time on these numbers. When you see a deal pop up, whether it is on the MLS or someone brings it to you directly, these metrics are your filter. They strip away emotion and hype and tell you whether the deal actually pencils out mathematically. Most beginners skip this step entirely. They fall in love with a property because it looks nice, or the neighborhood feels good, and they never run the numbers. Do not be that person. The beautiful thing is that none of these calculations are complicated. Seriously, you can do every single one of them with a basic calculator. The skill is not in the math itself. The skill is in knowing which numbers to plug in and making sure those numbers are accurate and realistic, not optimistic. So now you have the language. You understand NOI, cap rate, cash on cash return, the 1% rule, and ARV. These are your foundation. Every experienced investor runs these numbers almost reflexively. And once you get comfortable with them, you will start spotting good deals and bad deals almost instantly. All right, now that you understand how real estate makes money and the key metrics that tell you whether a deal is actually worth pursuing, it is time to zoom out and look at the main strategies investors use to put all of that into action. Think of this section as your menu. You do not have to pick everything on it. You just need to understand what is available so you can figure out which approach fits your goals, your timeline, and your current financial situation. Let us start with the most classic approach, buy and hold. This is exactly what it sounds like. You purchase a property, you rent it out, and you hold on to it for the long term. The goal here is steady monthly cash flow from tenants, while the property appreciates in value over years and your mortgage gets paid down. This is the strategy most people think of when they hear real estate investing, and honestly, it is the backbone of long-term wealth building in this space. It is not the flashiest, but it is one of the most proven paths to financial freedom. Next up, flipping. This is the one you have definitely seen on TV. You buy a property that needs work, you renovate it, and you sell it for a profit. The upside is you can make a significant chunk of money on a single deal in a relatively short period. The downside is it requires more active involvement, renovation knowledge, and a solid understanding of what that property will be worth after repairs. If you miscalculate your costs or your after repair value, a flip can go sideways fast. Then there is wholesaling. This one is interesting because you never actually own the property. What you do is find a deeply discounted deal, get it under contract, and then assign that contract to another investor for a fee. You are essentially the middleman connecting motivated sellers with buyers who have the capital. The barrier to entry is lower because you do not need a ton of money to get started, but you do need to be great at finding deals and building a network of buyers. Now, let me introduce you to one of my favorite strategies, especially for people who want to scale, and that is the BRRRR method. It stands for buy, rehab, rent, refinance, repeat. Here is how it works. You buy a distressed property at a discount. You fix it up, you get a tenant in there paying rent, and then you refinance based on the new higher value. Ideally, that refinance pulls out most or all of the money you originally invested, which you then use to go do the whole thing again. It is basically a system for recycling your capital over and over to build a portfolio without needing fresh money every single time. There are other approaches too, things like house hacking, where you live in one unit of a multifamily property and rent out the others, or short-term rental strategies where you furnish a property and list it for nightly stays. while other investors focus exclusively on commercial properties or land. The landscape is wide, but here is what I want you to take away from this section. No strategy is universally better than another. The right one depends entirely on you, your risk tolerance, how much capital you have access to, how hands-on you want to be, and what your end goal looks like. Someone who wants passive income and long-term wealth might gravitate toward buy and hold. Someone who wants to generate cash quickly might lean toward flipping or wholesaling. And someone who wants to scale efficiently might fall in love with the Brewer method. The important thing right now is not to pick one and commit forever. It is to understand the options so that when we get into this next section, you will see how all of these strategies connect back to one absolutely critical principle. And that principle, honestly, is the single most important thing I'm going to share in this entire video. If there is one single principle that separates successful real estate investors from everyone else, it comes down to 7 words. You make your money when you buy. Not when you sell, not when you refinance, when you buy. Let me explain why this changes everything about how you approach investing. Most people sit on the sidelines waiting for the perfect market. They say things like interest rates are too high, or prices haven't dropped enough yet, or I'll jump in when things settle down. And here's the brutal truth about that mindset. If you're always waiting for conditions to be perfect, you will never buy a single property, ever, because perfect conditions don't exist. The investors who consistently build wealth understand something different. They know that in any market, up, down, or sideways, there are properties being sold below their true value. There are motivated sellers. There are distressed situations. There are off-market opportunities that most people never see because they're too busy watching headlines instead of analyzing deals. So what does buying right actually look like in practice? It means you've done the work up front. You know what a property is actually worth because you've studied the numbers. You know what the repairs will cost because you've gotten estimates, not guesses. You know what the rent potential is because you've researched the local market. And after all that homework, the numbers either work from day one or you walk away. No emotion, no hoping it'll appreciate, no crossing your fingers. When you purchase a property at the right price with the right terms, you've essentially locked in your profit before anything else happens. Appreciation becomes a bonus, not a requirement. Cash flow becomes more predictable because you haven't overextended yourself. And your margin of safety protects you if the market shifts. This is a skill, not luck. It's a discipline, not a gift some people are born with. And it's available to anyone willing to do the analysis. The market doesn't determine whether deals exist. Your ability to find and evaluate them does. Now that you understand this core principle, let's talk about where things go wrong, because in the next section, we're covering the most common mistakes new investors make. And honestly, almost every single one traces back to violating this exact rule. Now let's talk about the mistakes that trip up almost every new real estate investor. If you can avoid these pitfalls, you are already ahead of the majority of people getting into this game. Mistake number 1 is overpaying for a property. Remember what we talked about earlier, you make your money when you buy. If you pay too much on the front end, no amount of rent increases or market appreciation is going to bail you out quickly. Too many beginners fall in love with a property emotionally and throw their numbers out the window. Do not do that. The numbers either work or they do not, period. Mistake number 2 is skipping due diligence. This means not getting proper inspections, not researching the neighborhood, not verifying rental comps, not checking title history. Every one of those shortcuts is a potential landmine waiting to blow up your deal months down the road. Due diligence is not optional, it is your protection. Number 3, and this one is massive, is underestimating expenses. New investors love to calculate their mortgage payment and their expected rent and think the difference is pure profit. Wrong. You have to account for vacancies, maintenance, capital expenditures, property management, insurance, taxes, and unexpected repairs. A good rule of thumb is to be conservative with your expense estimates. If the deal still works with higher expense assumptions, then you probably have a solid investment. Number 4 is analysis paralysis. This is the opposite extreme. Some people spend months or even years studying every possible scenario, running numbers on hundreds of properties, and never actually pulling the trigger. Education is critical, and that is exactly why you are watching this video, but at some point you have to take action. Perfection is the enemy of progress in real estate. The investors who succeed long term are the ones who learn these lessons early, ideally before they cost real money. Now that you know what to avoid, let's talk about how deals actually get funded, because understanding your financing options changes everything about what is possible for you. So you found a deal, you ran your numbers, you know your strategy. Now, the question becomes, how do you actually pay for this thing? Because here is the truth that stops most people cold. They assume they need to walk into a bank with a massive down payment and perfect credit, or the game is over before it starts. That is simply not the case. There are multiple ways deals get funded in real estate, and understanding your options is a huge advantage. So let me walk you through the main categories at a high level. First up, conventional loans. This is what most people think of. You go to a bank or mortgage lender, you put down a percentage of the purchase price, and they finance the rest. You pay it back monthly with interest over 15 or 30 years typically. Conventional financing usually offers the lowest interest rates, but it also comes with the most hoops to jump through: credit score requirements, income verification, debt to income ratios, appraisals, the whole nine yards. For your primary residence or your first couple of investment properties, conventional lending is often the go to starting point. Next, hard money loans. These are short term loans typically provided by private companies or individuals, and they are secured by the property itself rather than your personal financial profile. Hard money lenders care more about the deal than they care about your W 2. The trade off is that interest rates are significantly higher and the loan terms are much shorter, usually 6 to 18 months. This is why hard money is most commonly used for flips or BRRRR projects, where you plan to renovate and then either sell or refinance into a conventional loan quickly. It is a tool with a very specific purpose. Then there is private money. This is similar to hard money in some ways, but the key difference is that private money typically comes from individuals you have a personal relationship with: a family member, a friend, a colleague, someone in your network who has capital sitting around and wants a better return than what their savings account offers. The terms are negotiated directly between you and the lender, so there is way more flexibility here. Interest rate, repayment schedule, loan duration, all of it is a conversation. Building relationships with private lenders can be one of the most powerful tools in your investing toolkit over time. And finally, creative financing. This is the catch all category for deal structures that do not fit neatly into the boxes above. Seller financing is a big one, where the seller essentially acts as the bank, and you make payments directly to them instead of a traditional lender. Subject to deals where you take over someone's existing mortgage, lease options, partnerships where one person brings the money and the other brings the time and expertise. Creative financing is where experienced investors really start to separate themselves, because they can structure deals that work even when traditional lending says no. Now, I want to be very clear. I am giving you an overview of what exists out there, not telling you which one to use or how to structure any specific deal. Every financing method has risks, costs, and legal implications that you need to understand fully before you use them. Talk to a qualified mortgage professional, talk to a real estate attorney, do your homework. But here is why this matters so much. When you understand that there are multiple paths to funding a deal, you stop seeing money as the barrier and start seeing it as a problem to solve. And that shift in thinking is everything. Most people never buy their first property because they convince themselves the financing piece is impossible. Now you know it is not. There are options, and the right one depends entirely on your situation, your deal, and your strategy. Which brings us perfectly into the next section, because knowing your financing options means nothing if you do not have a clear plan behind them. So let us talk about how to build your own investing plan from scratch. Now, here is where everything we have talked about comes together into something personal to you, because knowledge without a plan is just entertainment. And I do not want you to leave this video entertained. I want you to leave with a roadmap you can actually follow. So before you go look at a single property, before you run a single number, I need you to sit down and answer three questions honestly. Number one, what is your goal? And I mean specifically, not just I want to build wealth. Everybody wants that. I mean, do you want $2,000 a month in passive cash flow within 3 years? Do you want to replace your 9 to 5 income in 5 years? Do you want to build a portfolio worth $1 million? Get specific, because your goal determines everything else. It determines your strategy, your market, your financing, all of it. Number two, Which strategy fits your life right now? Remember, we covered buy and hold, flipping, wholesaling, and brr. Each one demands different amounts of time, capital, and risk tolerance. If you are working a full-time job and have limited savings, that looks completely different than someone sitting on a pile of cash with flexible hours. Be honest about where you are today, not where you hope to be someday. Number three, what are your deal criteria? This is your filter. What market are you targeting? What property type? What is the minimum cash on cash return you will accept? What is the maximum you are willing to pay? When you define these boundaries ahead of time, you stop making emotional decisions. You stop chasing shiny objects and you start operating like an actual investor instead of a hobbyist. Write these three answers down. Seriously, put them on paper or in your phone right now. This simple exercise separates people who talk about real estate from people who actually build wealth with it. Now, coming up next, I am going to tackle the biggest objections and questions I hear constantly. Things like, is now even a good time, and do I need a ton of money to start? If you've been sitting here absorbing everything we have covered so far, I guarantee at least one of these thoughts has crossed your mind. So let us just address them head on. Number one, do I need a lot of money to get started? This is probably the most common thing people ask me, and the honest answer is no. You do not need a massive pile of cash sitting in your bank account. Now, does having capital make things easier? Of course it does. But remember, we talked about creative financing, seller financing, partnerships, hard money lending, wholesaling. There are strategies in real estate that require very little of your own money up front. Wholesaling, for example, you are essentially finding deals and assigning contracts. You are not buying the property yourself. House hacking is another one where you live in one unit and rent out the others, and you can get into that with a standard low down payment loan. So the idea that you need hundreds of thousands of dollars before you can even think about real estate investing, that is simply not true. You need education, you need resourcefulness, and you need to be willing to take action. Number two, is now actually a good time to invest? I love this question because people ask it every single year, regardless of what the market is doing. Rates are high, is it a good time? Prices are up, is it a good time? Market feels uncertain, is it a good time? Here's the truth, and I touched on this earlier in the video. You make your money when you buy. That principle does not change based on the calendar year. In every market condition, whether prices are climbing, falling, or staying flat, there are deals available if you know how to identify them and you buy at the right price. The investors who build lasting wealth are not the ones who try to time the market perfectly. They are the ones who learned how to evaluate deals properly and took action when the numbers made sense. So yes, now is a good time to invest if you buy right, and 5 years from now will also be a good time if you buy right. Number three, do I need to quit my job and become a full-time investor? Absolutely not. In fact, I would encourage most beginners to keep their day job, at least in the beginning. Your W-2 income actually helps you qualify for financing. It gives you stability and it takes the pressure off so you are not making desperate decisions. Plenty of incredibly successful real estate investors started and continue to operate on a part-time basis. You can analyze deals in the evenings, visit properties on weekends, and manage a small portfolio without it consuming your entire life. Real estate investing is one of the few wealth building vehicles that genuinely works on the side. And number four, the big scary one. What if the market crashes? Look, markets are cyclical. That is just reality. Corrections happen, downturns happen, and if you invest long enough, you will experience one. But here is what separates investors who survive and even thrive during downturns from those who get wiped out. It comes back to everything we have covered today. If you bought at the right price, if your numbers included conservative estimates, if you have cash flow covering your expenses, a downturn becomes uncomfortable but not catastrophic. The people who get destroyed in crashes are the ones who overpaid, over-leveraged, and ignored the fundamentals. If you follow the principles we laid out in this video, a market correction is not a death sentence. For many investors, it actually becomes an opportunity to buy even better deals. So those are the four biggest objections I hear, and hopefully you can see that none of them are actual deal breakers. They are just fears that dissolve once you have the right knowledge and framework. And speaking of having the right tools in place, I want to share something with you that directly ties into what we have been talking about throughout this entire video. We talked about how there are always deals out there if you buy right. That principle is everything. But here's the honest truth, especially if you're just starting out. Actually finding those off-market opportunities, the ones that never hit the MLS, is often the single hardest part. Without an existing network of wholesalers or agents feeding you leads, it can feel almost impossible to uncover those hidden deals. So let me share my top recommended tool for finding off-market properties. This is the exact software I personally use, and here's why. Think about the old school way of doing this. You drive around, spot a distressed looking property, write the address on a napkin, then go home and spend an hour trying to track down who owns it. This tool collapses that entire process into seconds. You tap the property, and it instantly pulls property records, ownership history, and mortgage details, so you know exactly who you're dealing with before you ever pick up the phone. It also has a feature similar to driving for dollars, where you flag distressed looking properties while you're out driving, and it automatically tracks your routes, so you never waste time doubling back through the same neighborhood twice. But if you don't want to leave the house, there's a virtual option that lets you scan neighborhoods and find leads from your computer, almost like driving for dollars without the gas money. Once you flag a property, it pulls the owner's contact information automatically, so you can reach out directly by phone, text, or mail. There's also built-in direct mail automation, if that's more your style, letting you send personalized postcards straight from the app without ever going to the post office. And beyond just finding leads, it helps you track them. There's a built-in pipeline so you always know which leads are new, which ones you've contacted, and which ones are close to closing, so nothing falls through the cracks. Honestly, you do not need any technical skills to use it. If you can use a map app, you can use this. Now, they offer a free trial, and I also have a free bonus checklist for you that walks through exactly how I use this tool to find deals. Everything, the tool, the free trial, and the checklist, is one click away in the description below. Everything I've shared in this video reflects my personal opinion and experience. I have an affiliate relationship with the tool I mentioned. That said, I only recommend things I genuinely believe in, so go check it out. Nothing in this video is financial, legal, or investment advice. Real estate results vary significantly depending on your market, strategy, and execution. There are zero guarantees here. Please do your own due diligence, run your own numbers, and consult licensed professionals before making any financial decisions. Always evaluate any tool based on your specific situation and needs. Congratulations, you've made it to the end. Here's what you need to take with you. Real estate in today's market is absolutely achievable, but only if you build it on three solid pillars. First, knowledge. You cannot skip the learning phase. Understand the market, understand the numbers, understand the risk before you ever spend a dollar. Second, strategy. Know your plan before you act. Are you flipping, holding long term, or generating rental income? Define that clearly, because without direction, every opportunity looks good, and that is dangerous. Third, execution. Use the right tools, the right data, and the right support systems to move with confidence rather than guesswork. The platform I discussed earlier gives you a real edge when you are ready to take action, and that free trial is waiting for you when you are ready. Sign up for my free newsletter, and I'll keep you up to date on the latest tools to keep growing and building wealth with real estate. Hit subscribe because we are consistently dropping content that builds real investors from the ground up. Go back to part 1 if you need to, run through all parts of this video, and then make your move. And that's the full deal. Thanks for watching.